Well, hello everybody, and welcome today to the BMT Tax Depreciation webinar on tax depreciation of all things. My name is for property professionals, so lots of real estate and property related people today, but a large number on. So thank you for coming along to learn a little bit more about depreciation. I think it's great to see such interest, given it makes such a big difference to investors. My name is Bradley Beer. I'm the CEO of BMT. I've been here for nearly 28 years. In that time in this business, we've done just under 1 million depreciation schedules. So we've done lots of them for lots of investors, helped lots of them save lots of money on their tax. And we're a business that are nationally spread. And I see there's everybody from across the country here today. We have about 200 staff and they are spread across the country. We need to inspect properties to do this job, so we've got them situated. They're all staff that do those inspections throughout the country. What I'm going to do today is run a session on, I guess, some, what is it, what's it about, what difference does it make? And I think that's something that's really important because as property professionals, you're either selling a property to an owner-occupier or an investor. If you're selling it to an investor, this makes a big difference. Hopefully I'll give you some tools to help you use it, to help you get more sales across the line. Otherwise, if you're here and you manage property for somebody, they're in that property to make some money. This makes a pretty big difference to that. So having some knowledge around it would be beneficial so you can have the right, smarter conversations with your clients. I think clients that have more money like to stay and they might tell their friends, and your job is either sell property to often investors or to manage it for them, and they're looking for some money, and this makes a substantial difference to the cash flow. I've got someone answering questions throughout the webinar because I'm one thing at a time person. And if we don't get those answered straight away, we'll just make sure they're in there the next 24 hours. And if you have other questions afterwards, by all means, email them in, respond. This is recorded. I'm happy for it to be given to other people within organisations, absolutely. And we'll answer those questions whenever they come up, not just now. What is it? What's it about? I think the easy way to explain depreciation is compare it to a car. When we buy a car, we drive it out of the shop and we understand what depreciation is pretty easily. It goes down in value often quickly at the start. With property, it's the same concept. The building, the structure, the carpet, the stove, all these things are wearing out over time and they decline in value or depreciate. The difference with a property as opposed to the car is that we're trying to have the overall property itself appreciate or go up in value as investors over time, which is how some of the money is made. The carpet still wears out, the bricks and mortar still wear out, and the tax office allows us, if it's an investment property, to claim a deduction for that wear and tear or depreciation on those assets. So significant amount, it's usually the second biggest tax deduction and makes a big difference to the cash flow. The average, I've got this a bit later, but the average first year deduction for our depreciation schedules last financial year was just over $12,000. That's the average across all different property types for the numbers of jobs we did in that financial year. So it does make a pretty big difference, in dollars to the overall numbers. Why do we do it? What's a quantity surveyor? I'm a quantity surveyor. I've done a building degree. I'm not an accountant. We've got to have some knowledge around the tax situation, but the main reason we are there is around construction costs. Quantity surveyors, traditionally, what they do is we measure and estimate the construction cost of buildings and also how much of everything's in there. So we get plans, we count the bricks, we measure the concrete, all the steel, all the carpet, the air conditioning systems, everything in a building we can measure, and that could be so you know how many bricks to buy, and also we then look at what would it cost to actually build it and work out those construction costs. Now, the claims that are made for depreciation do relate to the construction cost. So the tax office says or accepts the estimate by a quantity surveyor when you don't have all of these costs available. Even if you do have these costs, we then need to marry up and make sure we are splitting them out appropriately to get the most out of a property for depreciation. So it's about the compliance around the cost firstly, followed by knowing how to marry the expertise of the tax rules as well and get the most out of these properties. Now, I think the easiest way to give an indication of what does it mean for investors and keep talking about how it makes a difference. Let's just run a simple cash flow scenario on a property. Now I've got, the other thing I've got is tools that can help you use this in the future, but let's do the education piece or use it to help with your sales and with your clients. Let's run the simple scenario to start with and go, what happens to an investor if they, on a particular property here, 4-bedroom house, if they do or don't claim depreciation? What difference does it make and how does that work? So let's take a simple 4-bedroom house purchased for $950,000, let's say we get some rent for that because as investors we want to. Let's say that's about $900 a week. What that means is the income from this property will be about $46,800 per year. Now, in order to hang on to this property, we're going to need to pay the interest, the insurance, the management fees, the land tax, all the costs associated with that. So let's say with a few assumptions there that cost is around $60,000 for the year. What that means is, in order to hold this property, the investor needs to kick in $13,200 per year, or just over, or about $254 per week in order to make sure they maintain to pay the expenses in relation to this property. Now, that's not fantastic, but it does get a little better even without depreciation. The tax office or the rules in Australia allow you to make a deduction for that loss against your other income. So we finished the financial year, we lost $13,000 for having an investment property. We put that loss into our other tax on our salary, and we, assuming we're on a 37% marginal tax rate, which is where most investors sit. Marginal tax rates in this country are different depending on how much money you make. They're 30% or 37 or 48 or whatever they are, depending on your money that you make in the year. Most investors sit at 37%. So what happens is they do a tax return, they get $4,885 back. The cost to own that property now after tax, still no depreciation, is about $8,300 per year, just over, or about $160 per week. So that's a bit better than the $250. That's purely a loss that we made a deduction for. Now, out of a brand new property worth about $900,000, we see the depreciation claim being at about $19,500 per year. It's a brand new property. It's got lots of new stuff in there. It's very shiny, and construction costs are quite high at the moment. They don't seem to ever go down. They just keep going up. The deduction there of about $19,500. The difference between these two deductions, the $19,500 and the $13,200, is that the $13,202 the investor pays. That's the interest and insurance and all those costs. The $19,500 is a deduction for the building's wear and tear, wearing out over time. So they don't pay it out each year. It's a non-cash tax deduction, which makes it a lot more lucrative. Now we make a full deduction of $32,000, $32,702. The cash outlay before tax is still the same at that $13,000. And what that means is we get about $12,100 back in our tax return now. And the cost to own the property now for the year is just over $1,100 or about $21 per week. This is a simple cash flow scenario against the property. It is a negatively geared property. Whether it's negative or positive, the net result ends up, the net result of the difference in depreciation actually ends up the same. But in this scenario, a proper depreciation schedule makes $139 difference per week to the cost of owning a property. Now, I think if you're selling a property or you're managing a property, someone that thinks it's going to cost them $160 a week or $21 per week, it's easy to have your clients on the other side. $21 a week's a lot easier than $160 a week to fund. So if you understand how important this is and what difference that makes, as we've shown through that scenario, having that proper conversation at the time you're selling or when you're managing a property for someone, it's got to make you look smarter. It's got to make you make the client feel like you understand, and also they're more able to afford the property as well. If we've done some research over time, and we believe that 70 to 80% of investors are not claiming this deduction properly, not maximising it. If you've got a rent roll full of clients there, having the conversation about are you getting all the depreciation is not a bad thing if they're going to be back at $21 a week instead of $160 a week. If they are missing out, you want to make sure you have that conversation. You don't need to know everything. I've given you a fair bit of detail on a cash flow there, but for you, you know, you're selling this property or you're managing this property, you want to make it, you want to talk to them about how you make it work as hard as you can, get the most out of it that you can. We're not the expert, but depreciation, I've heard all about that. And we know the experts to help you with it, which is the quantity surveyor that can work those numbers out. I'm going to just run in not as much detail a second case study here, scenario on an older house, purely because I'll harp on a little bit about how secondhand property still gets depreciation deductions. It doesn't get as much, but it still gets some deductions and it still makes a difference. I want to say don't worry about age. We'll talk about dates in a moment that do make a difference, but always ask the question of whether there might be some deductions there. And if we tell you there's nothing, there's probably nothing. But don't worry about the age as to whether or not you're going to get deductions unless we tell you the other, unless we answer it that way. Now, let's take this little case study here. 4-bedroom house, built in 1996, and they've just bought it now. So it's 30 years old. It's not going to get as much as a new property. What have we got? $750 purchase, $580 a week rent, minus $275 a week is the cost. Now the depreciation we can see in the middle of the page there is not $19,500, it's $7,800. So it doesn't make as much difference, but it still makes a difference. $55 a week we can see over on the right by making sure we claim that depreciation. Lots of people would have thought that a 30-year-old house wouldn't have depreciation or wouldn't have much depreciation. We've gone in and we look at it, we see if it's there, there's deductions there, and it makes a difference. That $55 a week is probably still most of the management fee if you're looking after that property for them, or it might be even more than the management fee often. So having the conversation that makes you look like value is probably a time to do that if they're not doing it properly. I've blanket called it depreciation so far, but it's split up into two areas. A little bit technical here, but let's not bog down too often, but so you've got some knowledge about how it works here. One's called the capital works or the Division 43 allowance. Lovely tax office with their great different names for things. What it relates to is the structure, the hard stuff, the concrete floors, the walls, the roof, bathtubs, things that last a long time. The tax office says 40 years. How it works is, let's say a house costs $320,000 to build. For the structural component, you'll get 1/40th or 2.5% of that as a deduction each year, which is $8,000. This part of the deduction, to get it, it needs to be built after 1987. I don't want you to worry about age too much, other than if it's built after 1987, they're going to get a lot more deductions because the structure is expensive, as we can see, and it does make up a lot of the deductions you do get to claim. It's available for new property and existing properties, renovations and work that has been done to the property. If there's money being spent by somebody, it doesn't have to be the current owner, then there's potentially deductions in this Division 43 or capital works allowance. If it's built in 2016, as we say here, it's 10 years old. There's 40 years of claims in total, as I said, 2.5% each year. A buyer who buys this property now doesn't get the first 10 years, but they've got 30 left to go. 30 years of claims still at $8,000 per year if they bought that property with those sort of construction costs back then, or now that was built back then, sorry. The other part, plant equipment. These are things that don't last as long. Carpets, stoves, blinds, curtains, hot water systems, light fittings, I should use the examples on the page, dishwashers, things that don't last as long. The tax office allows us to claim them quicker. Dishwasher, they think lasts 8 years. It means it gets a deduction of 25% in the first year, $340 against a $1,360 dishwasher. There's diminishing value and prime costs, a couple of different methods. If you want to learn more about those, we can send you that. We won't get into those today, but 25% is much more than 2.5%. So the more of these things we've got, the more deductions we get in the early years. More deductions for the client means more cash for the client. These things to claim need to be new. You can't claim them on secondhand assets anymore for the last, since 2017, some legislation change. But we find these things if we can. If they put them in new themselves or they buy a new property, they get to claim for them, and we include them when we can include them, and obviously not when we can't. like you to remember that effective life for the property managers especially. We'll have got something to talk about a little later with that effective life that will help you in the tools. What sort of deductions we get out of different properties on average in the last financial year? This financial year is not finished yet, obviously, but as we can see, the average deduction out of a brand new property in that year was just under $18,000. The overall average about $12,100, so just over $12,000. You can see a lot of the stuff that we do is new, and obviously new property gets the most deductions. You can see by those numbers that's the case. It's still worth getting 4,600 as opposed to zero though, which is the ones that are built pre-87. So the pre-87 builds, there we can see on the first line, are the ones that don't get any of that structural allowance, but they may have had some renovations, or they likely had some renovations, or some work's been done to them, obviously, so there's still some deductions. It's a small percentage of our jobs, but the average first year is still $4,600, nearly $4,700. So substantial. So that's why I want to go, don't worry about the age of the property. Ask us, we'll have a look. We can see the photos pretty easily and give an indication of whether there's any deductions likely to be there. We can see the rest of the numbers though. Fair few people seem to buy things that are aged between 2004 and 2016, and they still get over $7,000 average in the first year there. See the percentage across those overall there. Even the second-hand properties that we can't get plant and equipment because it's second-hand, still have an average claim last year of $6,800. I just always want to say old properties still get, and it's the question, it is one of the frequently asked questions. Clients think their property's old and maybe there won't be deductions. Your answer is very simple. We've listened to the quantity surveyors and they say that new property gets the most, old property still potentially gets some deductions, it's not as much, but why don't we see if we can get you some money for that? Let's talk to the quantity surveyor, and you handball it from there basically. You don't need to be an expert, you need to know about that little sentence basically, and that covers all of that question around the older properties. I want to hit on renovations here. Reason did, we looked through through COVID, especially when there was some questions around the ability to inspect properties. We inspect properties to do depreciation schedules, and after looking at 100,000 on through COVID, because if I didn't have to go, we wouldn't. We believe that based on renovations and information that we find on site to make sure we're maximising those deductions, that inspection is a very important part of the process. 2/3 of those 100,000 had some sort of renovations. If you just use the original construction cost when you've been there 10 years ago or something, you may miss those renovations. So lots of properties have renovations. We go to them because we believe it's the best result that you get for the client. When there is enough data there to not go to them, then and we've got more of it than probably just about anyway, or definitely in our space, then it'd be nice not to have to go and bother the tenants and do all that. But the best result for the client comes out of visiting that property. Now, on renovations, two things to consider. We'll talk about the bottom here first. When people spend some money on a property, they put more things in there, so there's more things to depreciate, and you want to update those schedules to make sure they're taking advantage of the things that they add. But the first part there around before renovations start, scrapping, just remember the word scrapping. It's not the tax office word for it. They call it writing off the residual value of assets. Scrapping's easier to understand. Scrapping is when you throw things away, and if they have some depreciation value left, then you can claim instantly in that year when you throw them away or scrap them. I think the important thing to remember with this is that make sure there's a depreciation schedule in place before you rip it apart. It's a little hard for me to argue with the tax office about what's in your house if you've thrown it away. But if we've been there and we've done a depreciation schedule before and there's any value in that, and then you throw it away, we can go, all right, here's the photos. This is when we went, this date, you can see the kitchen. We've put a value on that at the time, and it's easier to justify an audit situation. An example of how this works that I'll run through because it makes a big difference is probably a kitchen. We've got a kitchen in the photo there. If you have a property that's say 30 years old now, you've just bought it, it's got a 30-year-old kitchen in it, 30-year-old kitchens, they're getting a bit tired. Kitchen is seen as part of the building. It's got 40 years of depreciation life, if you want to use that as the word. I know kitchens don't just fall apart suddenly at 40 years, but the depreciation claim goes over 40 years. If you decide to put a new kitchen in, you've rented it out for a while, and you go, okay, let's renovate it. Your client puts a new kitchen into that property and rips out a kitchen that's 30 years old. It's got 10 years or 1/4 of its life left from the original depreciation. So 25% or 1/4 of the value of that kitchen is potentially an instant write-off when you rip it out. You probably want to have a look at the kitchen before you rip it out, put a value on it and make sure that deduction's claimed. The thing about renovators is call a quantity surveyor first, make sure the depreciation schedule is in place, make sure there's enough detail collected at the site inspection so that they can actually pull the value of those things apart if they need to, because it can mean an instant substantial deduction. If you've got if that kitchen was only $20,000 30 years ago, there's still $5,000 of it left. Instant deduction the year you rip it out. Call a quantity surveyor before you rip it apart. That's the important thing there. Commercial properties. I get a continual question everywhere about whether we do commercial properties. Absolutely, yes. My surname is Beer, so we love a pub. To do those, they get deductions that are substantial from pubs, everything, restaurants, offices, warehouses. There's a lot of different rules around farms. They've changed substantially over the last few years through COVID, through instant asset write-off of businesses in farms and otherwise. Like they write off things like fodder storage and water storage and fencing really quickly to encourage farmers to build more of it, I suppose. The more water storage we've got, the more food storage we've got, I guess the longer we can last without rain and droughts, I suppose, as a farm, and the more food we can produce to eat. So we do all sorts of commercial properties, everything from the farms to the Melbourne Eye to the big rocking horse in Adelaide, all sorts of different things definitely have depreciation. Now, they do have the owner and the tenant as two parts of this. The owner claim of the building itself can claim what they own, obviously. The tenant may be the same person, maybe because sometimes the owner is the super fund and the tenant fits out for the business. Whoever owns what depreciates what they need to. We separate the reports between the two if necessary, or if it's the same entity, put them together. We'll run through a little, what sort of deductions come out of these sort of things. 800 square metre industrial unit here. Average first year 29, 5 years 134,000, 40 years $1.2 million. Substantial deductions, commercial properties. The one difference with, well, a couple of differences with commercial properties, obviously you don't sleep in them generally, but on top of that, commercial doesn't have the changes to plant and equipment like that second-hand plant and equipment can't be claimed. So if it's a second-hand commercial or non-residential property, the deductions are actually higher than they would have been if they were applied, those rules applied as they do to residential. So it's not as big a difference between the new and the second-hand deductions. Second-hand plant's still worth something, still get to claim for it. Every commercial or non-residential property pretty much has depreciation, as opposed to with residential, if you live in your house, you don't get to claim depreciation against it, obviously, unless you move out and use it as investment property. All commercial properties are investment properties. Even if you're using it for your own business, it's still got depreciation applied. The main questions. Doesn't my accountant look at after that? You come away from today and go, speak to a client, you talk about depreciation, they go, I've got a good accountant, my accountant looks after all that stuff. As I said before, 70 or 80% of investors are not maximising this deduction properly. They probably have an accountant, I'm sure they're great, but sometimes they just haven't sorted it out as well as they could. The other thing is, if you sell a property to someone, they haven't seen their accountant yet. Accountants are our friends, by the way, we work alongside them. Most of the work we do comes referred by accountants. What happens is they buy a property that you've sold it to them, you hopefully retain the management, you manage it for them, you do all the things that you do in that process, and then when they get to their tax return the next year, they go off to their accountant, they take all that information, they do a tax return, their accountant says, you should get a depreciation schedule if their accountant's good, and make sure we maximise the deductions out of this property. We go find them, as we said, an average of $12,000 in the first year in deductions, and they think their accountant is awesome, which is great, except, well, no, it is great. However, you as the person who sold them this property or managed this property for them already knew them. You knew they bought this property. You knew there should be depreciation in it. You know what the quantity surveyor does. Why don't you be the one that asks the question? Looks smarter than the average agent. Looks smart like the accountant. We get them $12,000. They think their accountant's awesome. We got them a lot of that deduction. That's fine. But you know this person. Why don't you connect that deduction to yourself as opposed to it running with the accountant? Very happy for them to speak to their accountant after you've suggested that. After we talk to them, they can talk to their accountant. We've done nearly 1 million of these things. Just about, I can't imagine there's too many accountants in Australia who haven't seen a BMT report against a property because we have a strong market share. The name is known. It's seen as quality. We maximise those deductions. We go to those properties. We're not scared of the accountant, but why don't you put yourself in front of it first? They are our friends. I think I've harped on about the old property. Old property still gets deductions. It may not get as much. Why don't we get the quantity surveyor, see if you can get some money? Your conversation is over on the old property pretty much with the client. Common areas. You own your piece of the strata areas or the common areas in a strata building. So underground car park, lift, expensive stuff. You own your piece of that, so you get to claim your piece of that. So in that site inspection, we go through and identify the common areas, identify everything that's in there, and make sure we get the most deductions out of the property. Furniture, if it's new in a residential property, furniture packs are plant and equipment, so they make a substantial difference to deductions. Make sure we include those, and we do include those in the reports, obviously. Is it ever too late? So you've got a rent roll of clients, or you've got clients you're selling properties to that are investors already in other properties. All these people that maybe you're missing out can actually go back pretty easily and amend 2 tax returns and maybe get some money back from the tax office. It's a bit like if you don't pay your tax, the tax office will find you eventually and make you pay it. They can go forever. As someone who hasn't done their tax properly or hasn't claimed everything they can claim, like depreciation, you can go back and say, hey, let me amend 2 tax returns and get some cash back potentially from the tax office. Even if they've owned it for 5 years or 7 years, they can't go back 5 or 7 years, but they can go back 2. We've got to assess that there's enough value in reassessing and making sure there's deductions there for those years, etc. But we don't do it unless they're going to get some money out of it, and it's easy to work that out. So if they have been missing out, there is some opportunity. What a great conversation to have with your client. I know we've been managing this property you bought 3 years ago. Not sure if you've done this property 2 years ago, whatever. Not sure you've done this property properly. Maybe we can help you get some more money out of this property by making sure this is done properly. We can give estimates of deductions. We'll talk about those later to make that easy. But it's a good conversation to have. As the property manager, I'm here to try and save you more money. Would you like to look at this? Now let's talk about the tools. I've got different tools for sales and property managers here that can, I guess, help use depreciation to make you look good or sell more stuff. I guess is the sell more properties is the first thing. So for sales agents and for property managers, the same here as well. Use depreciation to drive a sale. We can pretty easily give an indication of what sort of deductions might be available out of a property. We've just done John Street here, but we can give you these little estimates. You can take them to your open house if you want, or if you've just got a property that you know you've got an investor who's looking to buy it, and there's someone who's crunching their numbers, that should be crunching their numbers, knowing that the deductions are between $8,500 and $10,500 for depreciation done by the quantity surveyor is something that hopefully helps those numbers look a bit better for them, the after-tax cash flow. There is some clients that know how to calculate that. I've got a tool later I'll show you that people can use to help calculate that, but we can give you an indication of how much it's going to be before they spend any money or anything with us, to help you get the sale across the line. Basically, they look like that on the right, but they're done they're spoke to the actual property, and they're free. Same with these ones. We call these a phase A, or depreciation estimate for off the plan sales. We put a bit more detail into these. So if you're selling a project, we would have a look at a 3-bedroom and a 2-bedroom apartment in that project, or 1-bedroom, or whatever they are, and at different purchase prices for those size units. We could go, well, the deductions, look like this in the first 10 years. So someone that's really crunching their numbers on that property, you could use these documents, give them these documents that are free, to give them an indication of what those numbers would look like, and hopefully look better, and hopefully it helps get your sale across the line, basically. Prop calc. as I said, I've got a tool that can help you calculate help calculate the after-tax cash flow. Like those numbers we ran at the start, how do you do that? That's what we used to get asked when we calculate those depreciations. So we built this app. It's free, that people can use to calculate what that cash flow would look like once they've got that depreciation estimate. Now, as a property professional, unless you're a financial planner, you shouldn't do this for them. All you can do is, here's a tool, they can use it. It's like a calculator that's got a bit of detail in it, and they can use it. If they log in, they can save properties side by side and see what sort of deductions on two properties they're looking at, what's the after-tax cost of holding it between those. Gives a bit of other research and insights into the areas they're buying, a bit of census data and a few things like that as well. So it's a way, before anyone buys an investment property, I think they should crunch numbers on what it's going to cost them to own. I'm constantly surprised by people that don't know about depreciation until they go to their accountant. I don't know what numbers did they crunch on whether they could afford it. Anyway, that's an ongoing education piece, but this is an easy way for clients to actually calculate it. It's free, it's an app, and helps them out with that. Property managers, same thing around estimates. We've built a little tool here called New to Rent. If you're not on that, join it. It's free. What that does is, as you list a property for rent, providing it goes onto one of the websites that we do, I think it's from Domain, so it goes to Price Finder. We actually get that data, and if you're joined up to this system and there is enough data in there to generate this based on our algorithm we've built, it generates an estimate bespoke to that property that you've listed for rent. So all you've done is join this system. It doesn't have enough data inside the property data sites, etc., to generate it all the time. It only does the ones with enough data. The automatic one will get some of them. And what will happen is, you've joined this system, you've listed a property for rent, and then in your inbox turns up this little thing on the right that says, hi, 27 Smith Street. I think it should get around $5,000 to $8,000, or $5,000 to $10,000 it says on there, $5,000 to $8,000 in deductions. That is a PDF. You can forward to the client and say, hi, client, just thinking about you, did a whole bunch of work / nothing. Thinking about you, depreciation, have you thought about it? Ask your accountant about it. Just want to make sure this property is working as hard as possible. You can flick those out and see them very easily. Now, for ones that don't come automatically, because a lot of them won't because there's a lack of data, you can get the same thing. You've just got to come and ask us. Send us the address. We'll give you an estimate and address and how long they've owned it. We can, if you know that roughly, then we can identify what sort of deductions might be available, provide you one of these for your clients. Very easy to do, free, and it will make you look smart. If you want to see them all in the same place, we have a portal called My BMT where clients actually see their reports. They can see details about it. They can share their accountant. It's got a bunch of other things in there for the client, but there's also a part for the property managers where if you get these estimates, you can see them in there. You can just forward them straight away. You can forward them again. You'll see if we've done a depreciation schedule for the person, so you can kind of connect those dots. Join it if you want to. It's just if you want to have some sort of record of what's going on there. I think I've covered some of these things here. Boosting your competitive edge. Make the nice phone call. I want to make this property work. I want to make as much money for you can, Mr. or Mrs. Landlord. You don't need to know heaps other than some of those things today around not just old properties. Work with the accountant. Maybe you can get some dollars in the past. I'll probably still get some deductions. New gets the most. Why don't we talk to the coin surveyor experts and see if you can get any money? It's fairly simple to actually have those simple conversations. Now, I mentioned earlier to the property managers, especially here, sorry, sales guys, agents, something we built called Resi Rates. When you go to the tribunal and have an argument about someone's ruined the carpet, the tenant, the life of that carpet is actually the same effective life that we use to calculate depreciation of that carpet. Now, you can get all those numbers from the tax office's website. Good luck finding them, etc. So we built them into something called Resi Rates. We have got a list of them. There's about 170 items in a residential investment property that have an effective life. So when you go to argue, the 8-year life you can see on carpet up there. If it's 5 years old, it'll be someone will pay 5/8 and 3/8, depending on the tenant and the owner, and there'll be debate. That number of years is the important number that you'll actually need, and there's just a place to get it free. Once again, you can use that. We've actually put some rates against that, what sort of measurements and approximate costs against some of those things, which can be handy. These are available as PDFs. Just email back and I can provide those to everybody that would like them. But I know property owners seem to like that. It's free and it's the same thing that we use otherwise. So use that if you like. A few things about, I guess, BMT, bit of difference, hopefully. Firstly, what I'd like to talk to you about is the double the fee, or it's double the fee or you don't pay guarantee, basically. If you've got a client with an older property and they're not sure it's worth it, and then we talk to them about it and we go, you know what, we think there's enough here. If we're wrong, we don't charge them money anyway. If we're wrong, and the guarantee is if we can't find twice our fee in the first year in deductions, they don't have to pay. We just walk away. We don't finish the report, even if we've already visited it, because we should ask enough questions at the start about the property before we, you know, with nearly 1 million of them, we should know before we go there if we're going to find some deductions. We go there so we can get them all, but from the photos, we can get a pretty good indication of, is there enough things there to claim something for? So don't ever have the fear that they're going to spend some money and not get any, because we'll find deductions for them, or we won't charge them any money. Inspections, I know I've mentioned those. It's always a staff member of mine that does the inspection. We don't outsource that. It's an important part of the process. Our industry, since COVID, has decided, or some of them have decided, that it's easy to do it without inspecting the property. It will be cheaper. We're not the cheap guy. We're the guy we're the people that want to get the most deductions. It's easier to not inspect it, but the best results come if we find everything to maximize those deductions. We're thorough. We find every bench top. I had an example recently where, with a bit of investigation, looking into the property, when we were there, it looked like some different ceiling in the garage in the house, and poke your head up and realize that there's a whole roof structure been replaced because it leaked and rotted and whatever was whatever had happened there. There was over $200,000 in deductions that we may not have found if we didn't actually be thorough, go through that property and get everything out of it. The Institute of Quantity Surveyors also requires a bunch of disclaimers and would note that to do it properly, to cover and make sure you've got everything and maximize that deduction, and inspection is part of the process. So I know it's all over at the moment, and the quantity surveyors are telling your clients sometimes, we'll just do it off the photos. I don't believe that gets the best result. Be careful or wary of the client being, I guess, people thinking that's okay. ATO compliant, we do them all over the country, as we said, over $12,000 in the first year, and the fee's tax deductible. So when they pay the fee, it's normally $880 for a depreciation schedule. It's deductible when they do that, so they get some of that back in their tax as well. Involved, we talk to the client first. What do we do? How old is it? What's in there? How long have you owned it? A few questions about that. So before they buy it, we can talk to them about it and do it. And you don't need a schedule before you buy it, but an idea of what it might be. When it's settled, that's when you want to make deductions. If they're going to adjust their tax through the year, which they can do, you want to get that in place straight away before tax returns. Clients sometimes do that. You can have less tax taken out of your income. Their accountant does that, but they'll need a depreciation schedule to make sure that's done with all the deductions that are there. Tax time, it's time to think about it. When you renovate, before you pull it apart, remember, we've covered that, but that's the time to do it. After that, we get a bit of information about the property. Now, we've got access to things like the settlement date, the purchase price, and a lot of information via the websites that we get those. We confirm them and get them right with the client. So we get the first year pro rata correctly done, etc. There's a few things we're to do there to make sure that's right. After that, we do the inspection. We talk to the council. We talk to the people. We want to make that process very easy. Collect what information we can from elsewhere. Ask the client from the rest. After that, do a report. Claim them heaps of money. Make you look good. So we've got these slides will come to you actually already. I hope you guys and girls have learnt plenty from that. I think the key thing around it is often just the education. The clients think it's been looked after, or they don't know, or they think it's old. We've covered those things fairly detailed today. Register for new to rent, get estimates done. My team and myself are very happy to talk to you and your clients, anything depreciation. Happy with the accountant being involved in the process wherever need be. Thank you very much, and we'll let you get on with the day. Thank you.